Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today, we're going to talk about Social Security. And no, this won't be an episode dedicated to discussing all the doomsday headlines about Social Security going away, which, unfortunately, there's no shortage of those. But instead, we're going to give an overview of Social Security, explain how the system works, talk about some of the options and strategies when it comes to deciding when to claim your benefits, and also clear up some of the common misperceptions and concerns around Social Security. And while this topic may or may not be top of mind for you right now, depending on your stage of life, eventually everyone will have to make a decision around Social Security. So it's important to understand your options to determine the best strategy for your situation. And Andrew, as we all know quite well at this point, your son Grant is, of course, going to become some type of professional athlete when he grows up, and he's going to take care of you and Jenny in retirement. So obviously you won't need Social Security yourself, but are you still up for talking about it anyway?
This is going to be amazing foreshadowing if he does end up being a professional athlete, which I believe in you, buddy, but let's dive in here. And it's more fun to talk about receiving money from Social Security than paying into it.
Absolutely. So why don't you kick things off by sharing some background on it?
Sure. So at a very basic level, Social Security is money the government pays you, or returns to you depending on how you look at it, in retirement to help you cover your expenses. The way it works is that during your working years, you pay money in the form of payroll taxes to the government that goes into a bucket earmarked for paying out Social Security benefits. Then when you reach a certain age, 62 being the earliest, you're able to turn around and collect the monthly benefit from that same bucket you paid into during your working years. And if you look at your pay stub and go to that favorite section highlighting the taxes you pay, you'll see the payroll tax that's dedicated to Social Security taxes, which is referenced by the acronym OASDI. And OASDI stands for Old Age, Survivors, and Disability Insurance, and was the original name for the Social Security program, which I'm glad the government makes our creativity look a little bit above average there. And when looking at the amount you pay towards Social Security taxes, you only have to pay up to a certain amount of your wages, which in 2021 is $142,800. And each year this amount rises to keep up with inflation. So for the majority of physicians, you'll pay in the maximum amount of Social Security taxes throughout your career and will therefore be eligible for the maximum Social Security benefit in retirement. And even if you don't earn an income, which means you wouldn't pay Social Security taxes yourself, you may still be eligible to receive a benefit down the road. For example, if you're a stay-at-home parent, you may be eligible to receive Social Security payments based on your spouse's income, up to 50%, which is called a spousal benefit. And given this setup for Social Security, you can see that it's basically a form of forced savings. You pay in during your working years, then receive money back during your retirement. The original idea behind it was to provide a safety net, or minimum income, for people in retirement so they would have at least some money and income available regardless of how much they saved up themselves. However, for most people, Social Security isn't enough to fully fund your retirement, even if you're able to get the maximum benefit. So in reality, Social Security should be viewed more as a supplemental source of income to be used in addition to the money you've saved over the years. Having said that, this isn't an immaterial benefit, and receiving $40,000 plus per year in benefits helps to reduce the burden you have of fully funding your retirement through your own savings and investments. As we mentioned in prior episodes, when thinking about funding your retirement, we like to think about it as creating a quote-unquote retirement paycheck. When thinking about creating your paycheck in retirement, it's based on the resources you have available, which consists of your savings and investments, like your 403bs, 401ks, IRAs, and income sources like a pension, part-time work, and Social Security. So thinking about this retirement paycheck, the money you receive from Social Security is money that you don't need to withdraw from your savings and investment. In other words, it helps to reduce the burden of funding everything from your own savings and investments and provides more cushions for your overall retirement plan. And each person is eligible for a different Social Security amount based on several factors, looking at their age, earnings history, how long you worked, and when you elect to start receiving benefits. Calculating your benefit and options may seem more complicated than it really is, and at any point, you're able to check and see what your projected payment is. If you're over age 60 and have never registered for a My Social Security account on the government's Social Security website, you'll receive a benefit statement in the mail. Otherwise, the easiest way to check your estimated benefit is to create an account on the website by going to ssa.gov/myaccount and clicking on Create an Account, which will include a step-by-step PDF guide in the show notes that walks through this process of creating a My Social Security account so you can see what's involved and how to do it. And once you have your online account created, you can log in to view your earnings history and your projected Social Security payment. You'll also see how your projected benefit is different depending on the various ages you elect to start receiving benefits, which is an important part of deciding on your Social Security claiming strategy.
Yeah, and this is where it can start to get a little into the weeds. So we'll try to keep it high level and touch on the typical situations rather than the nuances and exceptions. So when it comes to claiming Social Security or deciding when to start collecting your Social Security payments from the government, you have several options. Each person has a certain full retirement age for Social Security purposes, which is defined as the age at which you're eligible to receive your full Social Security benefit. And full retirement age is a moving target for the Social Security system, and your full retirement age depends on when you were born. If you were born between 1943 and 1954, your full retirement age is 66. If you were born between 1954 and 1960, your full retirement age is somewhere between 66 and 67. And if you were born in 1960 or later, your full retirement age is 67. So in a few years, that's what everyone's will be. Now, this concept of full retirement age, where you can receive your full Social Security benefit, is somewhat deceiving. And the reason why is because you can choose to claim Social Security as early as age 62 or as late as age 70. And if you choose to claim earlier than your full retirement age, your Social Security payment will be decreased. But if you choose to claim later than your full retirement age, your payment will be increased, even beyond your quote-unquote full Social Security benefit. The basic idea here is that you can claim anywhere between 62 and 70, and the earlier you claim, the lower your benefit will be, which makes sense because if you're claiming earlier and collecting more years of payments, those payments should be lower. To provide some context, if you decide to start collecting Social Security at age 62, rather than at your full retirement age of somewhere around 66 or 67, your monthly Social Security payment would be 30% lower than it would have been if you waited until age 66 or 67 and collected your full benefit at your full retirement age. On the flip side, if you decided to wait beyond your full retirement age and didn't start collecting until age 70, you would collect the maximum possible benefit, and your monthly benefit would be 25% higher than it would have been at full retirement age. So you can see there's a trade-off here, and you have to decide whether you want to start collecting your Social Security payments earlier and have a lower monthly payment, or start collecting them later and have a higher monthly payment. And there are a few nuances involved, which I'll touch on in a bit, but if you're looking to maximize your lifetime Social Security payments, the decision of whether or not to delay basically comes down to a simple math equation. If you wait to collect your benefits past age 62, you'll have passed up a certain number of months of lower payments, but when you start collecting, you'll receive higher payments. So how many months after you start collecting will it be before that higher monthly payment more than makes up for those earlier months of missed, smaller payments? And this is referred to as the break-even point, where your cumulative lifetime Social Security payments from delaying exceed the payments from having started earlier. And for most people, this break-even point is around 13 years. So if your full retirement age is 67 and you decide to delay collecting until 70 in order to receive the maximum possible benefit, around age 80 is when the decision pays off, and you're better off for having decided to delay collecting Social Security from that point on. Now, obviously, you have to live that long for the decision to pay off. So at the most basic level, the Social Security timing decision, from a purely financial perspective of wanting to maximize your lifetime benefits, comes down to life expectancy. The longer you live, the more the decision to delay works in your favor because you pass the break-even point and have more years where you're collecting that higher benefit.
Yeah, just another reminder of how financial planning would be a lot easier if we knew the exact day we pass away.
Yeah, that would certainly help, especially with planning for that last check to bounce.
Yeah, exactly.
So unfortunately, there isn't a way to guarantee that you'll be better off with one strategy versus another, but you can at least make an educated decision, which is the goal. Another thing to keep in mind when thinking about delaying is that the situation where delaying ends up paying off the most is the same situation that's the biggest risk to the savings and investment side of your retirement plan. So in that sense, it's a nice hedge. If you think about the savings and investment side of your plan, the main risk you're concerned about is running out of money during retirement because 1, you live too long and have to withdraw from your portfolio for too many years. 2, investment returns are poor, so your portfolio doesn't grow as much as expected. And 3, your living expenses increase significantly because the cost of living increases due to high inflation. So looking at Social Security as a hedge to running out of money, it's basically the opposite in every aspect because 1, you receive payments each month for the duration of your life, no matter how long you live. 2, the quote, return on your investment from delaying is guaranteed, and it increases the longer you live. And 3, Social Security payments are indexed to inflation. So the more inflation and cost of living increases, the more your Social Security payments increase to keep pace with it. So as you can see, when thinking about your overall retirement plan, Social Security is basically the opposite of your retirement investment accounts in terms of the way it acts and the scenarios where it's particularly beneficial. So in that sense, delaying Social Security, if you're able to, provides a nice hedge for your overall retirement plan during the later years. And one last point on the benefits of delaying, which we've touched on in prior episodes, including episode number 15 on tax planning and retirement, is that delaying Social Security provides more flexibility from a tax planning perspective. The reason for this is that by pushing your Social Security income further into the future, you have more years between retirement and Social Security where you have freedom to determine your taxable income based on how you withdraw from your retirement accounts. This provides more flexibility to do proactive tax planning strategies like Roth conversions to smooth your retirement tax rate and minimize your retirement tax bill. So that's an overview of Social Security claiming strategy and the case for delaying. But now we want to spend some time talking about the other side of the coin and some of the situations or considerations where it might make sense to start collecting Social Security earlier.
Yeah, and the most obvious one here is health concerns. And as Trent explained, one of the biggest factors in the timing decision is how long you expect to live, which, unlike the stock market, can't be perfectly predicted. You're not going to call me out there, Trent?
Well, I thought you were going to fill me in on your stock market trick after the podcast.
Fair enough. And I guess for compliance purposes, I should probably add that was a joke. And unfortunately, you can't perfectly predict the timing of the stock market.
Who doesn't love compliance disclaimers?
Exactly. So going back to why your life expectancy is so important to the math here, in order for the math of delaying to work out in your favor, you need to reach a certain age to hit that break-even point where the higher monthly payments compensate you for starting later. If you know the break-even point for delaying is age 80, and your family health history or current health suggests a strong likelihood that you won't make it that far, it might make more sense to claim early, knowing that you'll receive a lower monthly payment than you would have been if you delayed, but you'll receive more of those payments. Another situation where it might not make sense to delay is with spousal benefits. As mentioned earlier, even if one member of a couple is a stay-at-home parent and doesn't have much in the way of their own earnings history and Social Security benefit, they may still be eligible for a spousal benefit based on their spouse's earning history. There are some requirements here, including the fact that the earning spouse must claim their own Social Security benefit before the non-earning spouse can claim theirs. But assuming the non-earning spouse is eligible to claim theirs, they have to decide when they want to claim it between age 62 and 70. The difference here is that unlike with a regular Social Security benefit based on your own earnings history, for a spousal benefit, there's no incentive to delay collecting it beyond your full retirement age. And this is because your spousal benefit maxes out at your full retirement age. In other words, unlike receiving benefits based on your own earnings history, there's no increase in your monthly benefit past full retirement age. So whether you collect at age 67 or at age 70, the monthly payment is the same, and therefore there's no financial reason to delay collecting it beyond your full retirement age. Another situation where it might not necessarily make sense to delay is when there are two earning spouses who are each entitled to their own benefit. The way Social Security works for spouses is that there's something called a survivor benefit, where if your spouse passes away, you're entitled to a Social Security benefit based on their age, earnings history, and benefit amount. There's some nuance to it, but at a basic level, assuming you're both collecting Social Security payments in retirement and your spouse passes away, you're able to choose between your current benefit amount or what your spouse's had previously been, whichever is higher. Because of that, although not as common, there are situations where it can make sense to have the higher earning spouse delay their own benefit until the maximum age 70 and have the other spouse start collecting theirs earlier, whether that's at full retirement age between 66 and 67 or potentially sometime sooner. The idea here is that even if the spouse who delayed doesn't live to the break-even point for their own benefit, when they pass away, the lower earning spouse will be to switch from their own lower benefit to the higher benefit of the spouse who delayed. And if the spouse who delayed does live long enough to reach that break-even point, the delay decision worked out well and the lower earning spouse was able to start collecting payments earlier with the option to switch to the higher one at some point in the future. The scenario where the strategy tends to work out the best is when one of the two spouses is younger and has a longer life expectancy. In this situation, by having the younger spouse claim earlier, they can collect their own benefit for a number of years and also know that when their older spouse, who delays filing for benefits in order to maximize their benefit, eventually passes away, they'll be able to switch to their spouse's higher benefit. So that covers a few of the cases where it can make sense for either one or both spouses to claim their Social Security benefits early rather than delaying, which I know may have been a little bit more in the weeds than usual. But wrapping up the decision around when to claim Social Security benefits, I'll give a summary of the claiming strategies and a couple general rules of thumb. So for any given couple, there are basically three options when it comes to claiming Social Security benefits, which fortunately or unfortunately was reduced several years ago as they phased out several other claiming strategies. So looking at the three options for a married couple, you have number one, both delaying collecting benefits. Number two, only one of you delays. And number three, neither of you delays and instead both claim early. For scenario one, it generally makes sense for both members of the couple to delay when both are in very good health and expect to live beyond their break-even point. For scenario two, it generally works best for one member of the couple to delay when both spouses have a normal or average life expectancy, or one spouse is expected to live longer. And when following this strategy, the best approach tends to be having the higher earner delay and the lower earner claim their benefits as early as possible. And lastly, scenario number three of both spouses claiming early makes the most sense when both are in poor health and aren't expected to live beyond their break-even age. So that's a quick summary of the claiming strategies, but as you can tell from our discussion, it's a very personalized decision based on the specifics of your unique situation, and the right strategy for one person might not be the right strategy for another. So with that in mind, while we wanted to cover some of the considerations here and share some perspective on what approach can work best in general, we always recommend confirming with your financial advisor or a qualified expert to confirm what's the best strategy for you, given how big of a difference the timing of when you elect to receive your benefits can have on your overall plan.
So now that we covered some background on Social Security and some of the claiming strategies involved, we'll switch gears a bit and cover a couple of the common misperceptions around Social Security, since there are several of them. And the first one is the idea that you have to start collecting Social Security when you retire from your job and stop working. We touched on this when discussing claiming strategies, but just to reiterate and make it clear, you're allowed to collect Social Security anytime between age 62 and age 70, regardless of whether or not you're actually retired. For example, you could stop working at age 60 and then wait 10 years until age 70 to claim Social Security. Or on the flip side, you could start collecting Social Security at age 62, but then continue working until age 68. When you're allowed or required to collect Social Security is not linked to when you retire from your job and stop working. And following the scenario I just mentioned, where someone decides to collect Social Security while they're still working, another common misperception out there is that there's a penalty or you lose some of your Social Security benefit if you start collecting it while you're still working or earning income from other sources. And while this does have an impact on your Social Security benefit, you don't lose it or receive a penalty, which I'll explain. When it comes to Social Security, there's something called an earnings test that says if you start collecting Social Security while still working and earning income, your benefit is reduced based on your income. And there's a formula involved, but if you claim Social Security prior to your full retirement age and are still working, your annual benefit is reduced by $1 for each $2 of income you earn over $18,960, which is the threshold for 2021. During the year of your full retirement age, the equation changes slightly and your benefit is reduced by $1 for every $3 you earn over the 2021 threshold of $50,520. Beyond your full retirement age, the earnings test goes away and is no longer relevant, so you receive your Social Security benefit regardless of how much you make. So yes, if you collect Social Security prior to your full retirement age and are still working during those years, your benefit is reduced. However, the reduction in your benefit isn't actually lost, as many people tend to believe. It's simply pushed into the future. The way this works is that once you reach your full retirement age, your Social Security benefit is adjusted upward to incorporate the quote-unquote lost payments in the years leading up to your full retirement age. So understand that any benefits that are withheld from your Social Security payments for continuing to work prior to your full retirement age aren't actually lost. They're simply delayed into the future, and you start to recoup them once you reach your full retirement age. And one last misperception, which isn't as common but can still cause some confusion, is around the taxation of Social Security payments, and specifically the idea that they can be taxed at an 85% rate. The way taxation of Social Security works is that the amount of your payments that you have to pay taxes on is based on your income. There's a sliding scale, but if you're a married couple filing taxes jointly and your 2021 provisional income, which is basically your adjusted gross income plus half of your Social Security income, if that's above $44,000, you'll hit the maximum level where 85% of your Social Security payments are taxable. However, this doesn't mean it's taxed at an 85% rate. It just means that you have to pay taxes on 85% of your Social Security income at whatever your marginal tax bracket is. So for example, if you're in the 24% tax bracket, you'd pay taxes on 85% of your Social Security income, but you would only pay a 24% tax rate on that income. So just wanted to mention that so you can understand how the tax side works.
All right, so to wrap things up, I'll touch on some of the bigger questions, especially more recently, around the concerns about Social Security going away. And without a doubt, the most common one we hear is around the sustainability of Social Security and whether it's going to run out of money. And it's not surprising to hear this because of the way the media discusses Social Security and sharing doomsday headlines about when it's going to run out of money without discussing any of the details behind the scenes. It's not to say the headlines aren't accurate on the surface, but they can be misleading. In some senses, it's like saying Michigan football didn't lose to Ohio State in 2020. Yes, it's true, but the game was also canceled because of COVID. And so looking at this stability concern, it's helpful to first understand how the system works. Social Security is a pay-as-you-go system where people are currently working, are paying taxes from their paychecks, and the government then turns around and uses those taxes to pay Social Security benefits to the people who are retired and collecting Social Security. In other words, you can think about it like a pension, but from the government. Because it's a pay-as-you-go system, the government doesn't need some big pile of money sitting on the sidelines to use in order to pay out Social Security benefits. However, with changing demographics and more baby boomers retiring, we're now at a point where the taxes being paid by workers are less than the benefits being paid to retirees. This has resulted in the need to dip into the Social Security trust fund that have been built up over the years of more money coming in than going out. Obviously, on the surface, just like someone spending down their own money at a faster clip than what they're bringing in, eventually this means the money or bucket they are pulling from will be depleted. This situation is unlikely to change anytime soon, and because of that, if nothing has changed with the Social Security system, eventually that pile of money, the Social Security Trust Fund, will be depleted and there won't be enough money available to pay the full required Social Security benefits to the people who are retired. So when you see the headlines about Social Security, quote unquote, running out of money, they're referring to the Social Security Trust Fund and the dynamic that I just mentioned. However, there are several important things to know here, which is why the headline may appear more dire than it really is. The first is that even if nothing changed, more than 70% of the Social Security benefits projected to be paid out over the next 100 years would be covered by people who are already born and will be working and paying Social Security taxes in the coming years. So under an extreme worst-case scenario, everyone would still receive the vast majority of Social Security benefits they have earned and have been promised, and the idea that Social Security would suddenly run off a cliff and payments would go to zero simply isn't possible based on the nature of the system and how it works. Second, when we talk about the Social Security Trust Fund running out of money, that's not scheduled to happen until around 2033. So there's still a lot of time to make changes. And it's similar to a car driving straight towards the edge of a cliff. Yes, if you did nothing, you'd go over the cliff. That doesn't factor in the ability to stop, go in reverse, and change directions to avoid going over that cliff. And lastly, we've been in this position before. In fact, the last time this happened was in 1983 when the Social Security Trust Fund was about to run out of money. So what happened then? Well, the government made some small changes to tax rates in the Social Security system, which extended its solvency for another 50 years. So there's clearly a precedent for this situation and making fixes, and the fixes required aren't even that significant. For example, in 1983, the full retirement age was changed from 65 to 67. So perhaps it's changed again to 70, which alone would have a huge impact. The government could also increase Social Security tax rates or increase the wage cap of earnings that are subject to Social Security withholding taxes. So there are many different options available, and in all likelihood, we'll see another round of legislative changes and reforms to the system before 2033. Now, knowing the way politics and legislation works, it's likely that politicians will wait as long as possible to actually address it. So we'll probably see more and more stories and headlines as we get closer to that date of the Social Security running out of money. But Social Security is something that's too important and politically sensitive to not be addressed eventually. So from our perspective, it's something we're aware of and monitoring, but we aren't overly concerned about it. So hopefully this helps you better understand the full picture of the Social Security system and some of the underlying dynamics versus what you read in the headlines.
Well, that covers it for today's episode. And Social Security is definitely an interesting and popular topic, especially for anyone who's approaching retirement. And as you can see from our discussion, there are a lot of intricacies and misperceptions around it. So hopefully the discussion helped clear some of these up and give you a better understanding of how Social Security works and also some of the things to consider with your claiming strategy. And just to review what we covered. So, number one, Social Security is money you receive from the government each month to help cover your living expenses in retirement and supplement the other resources that help fund your retirement, such as your savings and investments. Number two, Social Security can be claimed anytime between age 62 and age 70, and there's a benefit to delaying because your monthly payment increases for each year you delay collecting Social Security. Number three, because of this dynamic, where delaying means a higher monthly payment amount, but fewer months of payments received, there's a break-even period where you have to live to a certain age before the benefit of higher monthly payments more than outweighs the fact that you waited longer to start collecting those payments. And for most people, this break-even age is somewhere around 80. Number four, as a general rule of thumb, it makes sense for both members of a couple to delay if they both have very good health and expect to live beyond the break-even period. It makes sense for one member to delay and the other to collect early when both members have normal life expectancy or one's expected to live longer than average. In this case, it's best for the higher earner to delay and the lower earner to collect as early as possible. And lastly, if both members of a couple are in poor health and have low life expectancy, it makes sense for both to collect early since they don't anticipate reaching the break-even age. However, these are just general guidelines, and this is a very individualized decision based on your unique situation and several different variables, so make sure you consult with a qualified advisor before making your own claiming decision. Number five, to clear up some of the common misperceptions, you don't have to start collecting Social Security as soon as you retire. Your benefits are reduced if you're collecting prior to full retirement age and still working, but the reduced benefits are simply delayed rather than lost, and your benefit is adjusted at full retirement age to make up for it. And lastly, from a tax standpoint, up to 85% of your Social Security income is taxable, but you pay taxes on that money at your marginal tax rate, not an 85% tax rate. And lastly, number six, while we hear a lot of concerns about the sustainability of Social Security and it, quote unquote, running out of money, this actually isn't a big concern because of the way the system works and the fact that small changes in legislation and taxation are required to extend the sustainability of Social Security by a significant amount. And it's extremely likely that these changes will be made at some point. Well, thank you to everyone for joining us for another episode of the show. You can find the show notes for this episode at mdwmllc.com/podcast. And as mentioned, we'll include in there a step-by-step PDF guide on how to set up a My Social Security account, as well as a guide for how to actually apply for Social Security. And as always, if you have thoughts to share or questions you'd like to have answered, please email us at info@mdwmllc.com. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.